It's the end of the day with Ray. Hello, my friends. Well, today we're going to jump on that Sharp Interactive board. I want to go through Konica's third quarter. I will tell you this won't be one of those short videos. We see a lot of folks in the industry doing these short videos. I guess a short video of Konica Minolta's third quarter financials would go like this. Hey, Konica Minolta had a fantastic quarter. They knocked it out of the park. They had some operating profit in the digital workplace and the professional print sector. Everything's fantastic. Don't worry about anything. We'll see you all next quarter. That's how most of our industry would describe the Konica Minolta financials. But I got to do it a little bit different. I actually have to go to Konica Minolta's website under the tab, Konica Minolta Investor Relations, pull down all the information, go through all this information, look at it, study it, start looking on the internet, and start really understanding what's going on at Konica. Because I like to give you kind of a thorough presentation. Again, all the information I'm going to talk about today came right off of Konica Minolta's website, Investor Relations, just like it does with all the other OEMs and all the other players that I talk about that are publicly traded companies. The information's out there for all of you to seek, explore, learn from, and ask questions about. And hopefully more and more of us will do that. As our industry transitions, we got to kind of know what's going on. And the reason that I'm get really detailed around Konica Minolta is because Konica Minolta was really that shining star, and I've talked about this before. They were the organizations that ran around and bought 15 companies. I'm going to share with you a little bit about their acquisitions. But 15 companies over the last, actually, excuse me, folks, 24 companies over the last 15 years. 24 companies over the last 15 years around the ECM space, IT services space. They even bought that ERP company. So they've been out there actively acquiring organizations to help them with the transition. And on the surface, that all looks fantastic. The industry's got a transition. Konica Minolta's out there gobbling up all these assets. But the question is, and it's a serious question, where's the momentum in all those acquisitions? Where's the momentum in IT services? Ladies and gentlemen, I've said this and I've been saying it for a long time. Can a manufacturer of products really go into the marketplace and deliver services? Can it even happen? Is it even logical? Can a manufacturer of products really go into the marketplace and deliver services that might not even include any products? And it is very, very interesting. You know, I looked at Konica Minolta's articles of incorporation. And I was going to share them on today's episode, but it would kind of get too lengthy. But you should all go out there and look at their articles of incorporation because they're out there. And it describes what the company does. I think there's like 25 or 26 bullet points, if you will. Every one of those starts out with the manufacturing of. And it's a mindset. They're manufacturers. Can they really come into a marketplace and deliver services? This is the question. And I'll continue to ask this question until, whether it's Konica and Ricoh the same way with their mind shift and all their IT aspirations, until these organizations can really start sharing the details around these non-manufactured things. What are the details around these services that you inspire to deliver to the marketplace to change the world, to help the world digitize the DW and DX strategies? What are those when relating to revenue and profit? What does that mean for the industry going forward? So without any further ado, let's jump on the Sharp Interactive board. I got a lot to talk about here today, but stick with me, and I'm hoping today's episode will inspire all of my friends to start digging into the financials of all the OEMs and asking some serious questions. The first thing I want to do is go back in time, and I know a lot of you think, oh, Ray, you're just beating on Konica about, you know, what happened in 20 and 2021. I'm not beating on Konica about what happened in 20 and 21, but it's a reality. In those 2 years, their operating profit loss was $294 million. Between those 2 years, it was $294 million in operating profit loss. And folks, here, I get it, okay? In 2020 was a tough damn year for the whole world. But if we're delivering IT services and we bought assets over a period of 15 years and we bought 24 companies, you would think that in the year 2020, we'd have been able to capitalize on a lot of that migration to the cloud. And how are we capitalizing it if we were? The numbers are here, and I'm going to share those numbers with you, what they categorize in the DW and DX category where IT services lives. But there's some interesting things regarding those numbers. But at the end of the day, that's a big hurdle to overcome as you start into 2022, $294 million that you lost in 20 and 2021. But here we are, we're 9 months into FY 2022. So 9 months in, total top line revenue for the company is $6.2 billion. Operating profit is at $26 million. So it is not in the red, which is fantastic, okay? We don't want to be in the red. That's not good. So we're in the black, $26 million. That represents less than 0.5%. Less than 0.5%. So we got a long way to go. This isn't time to start cheering, spiking the ball. We got a touchdown, okay? And I think Konica gets that. We got a long way to go. And unfortunately, our economic times that we're in, Fed just raised the rate again. There's rumors they're going to raise it again. You know, the weakness of the yen. There's still a lot of things out there. It's not just about getting some supply chain issues resolved. And I'll talk about that a little bit as we get further into this. But I do want to say, and with all sincerity, it's great that Konica Minolta is not in the red 9 months in. It looks like by the end of this year, you know, if they can stay on track, they'll be in a positive profit position. That'll be a great thing. Before I get into the digital workplace and the professional print categories, because that's what we all care about, you know, the print people, right? We care about what were the revenues in those groups. I want to talk about our good friend Orlando Bravo, and we all know Orlando Bravo, right? I mean, folks, I've been sharing some of his quotes that he puts out there frequently, but the one I really like is we can't chase revenue at all costs, and we have to change the momentum to a momentum about profit. And I strongly suggest that you follow Orlando Bravo on Twitter, but I want to read a couple of his latest tweets because they just fit so well into our industry. I mean, if our industry actually listened to what Orlando Bravo was saying, they might actually change course, which would be great, right? So fundamentally, investors don't buy stories, they buy numbers. Fundamentally, investors don't buy stories, they buy numbers. Think about all the stories the investors have heard in our industry. There's been a lot of stories about the transition, position perfectly, understand finance, they can go out there and change the world of IT. All the stories we've heard for over a decade. Guess what? The investors are going to now want to know about the numbers. They're pretty much done with the stories. Think about that. Over the last decade, many investors mischaracterize wasteful spending as investments in growth. Wasteful spending as investments in growth. Can't do that anymore, folks. Those investors are unlikely to repeat that mistake for some time. Management teams that adjust and focus on profitable growth will be the ones rewarded going forward. It's all about what? Profitable growth. We have to change our thinking. It's not going to be about revenue growth. It's going to be about profitable growth. And when you move into the services space, let me tell you something. If you focus on being profitable in services, guess what's going to happen? You're going to build really great efficiencies that will actually make you a remarkable deliverable because you're managing something with discipline. And you'll go out there and you'll get your revenue growth along with it. But don't focus on chasing the revenue so you can ring the bell. Focus on improving the profit. The momentum has to be toward profit. This is a quote that Orlando put out there that, boy, I'll tell you what, this really hits home to our industry. Astonishing the number of private companies that continue to buy their way to growth instead of organically building a real company. God, you think about that. What was I been saying? I've been screaming about this for a long time. Quit buying up declining revenue. What are y'all doing? Well, they were listening to stories. That's what they were doing. And now, what are we doing? We got all these assets that we gobbled up. We're struggling with some profitabilities. And is it about time that we focused on profitability? Is it about time that we focused on growing organically as opposed to running around and trying to buy the revenue? And here's one I really thought was interesting, and this has to do with Elon Musk buying Twitter. But boy, this is pretty profound. And I think as we look at our industry and we look at some of the tough decisions that are going to have to be made, this quote from Orlando Bravo could be pretty powerful for y'all to listen to. Powerful case study from Elon's acquisition of Twitter. 1, if you decided not to partner with existing management, make leadership change immediately, no transition. You go into an organization, you know that these are not the right leaders, you make a change immediately. There's absolutely zero transition. Kind of worked for Elon, didn't it? If restructuring is needed, start day 1. No 180-day transition period. You know? No consulting studies that go nowhere. Just do it. Pretty powerful stuff, and that all pertains so well to our industry. But let's look at the digital workplace. The top line revenue for the 9 months of FY 2022 is $3.3 billion. And the top line revenue for professional print is $1.4 billion. And ladies and gentlemen, those are pretty strong numbers, but I got to ask the question, are we chasing revenue at all cost? Or are we collecting revenue based on a profitable collection method, if you will? Okay? Are we out there getting revenue, but we're paying attention to how we're profitable on the revenue we're getting? Because when you look at the operating profit, I'm going to share my thoughts on this. On the surface, everybody would say, well, they made operating profit. This is fantastic. Let's talk about this. Digital workplace, they had $11.4 million operating profit on $3.3 billion in revenue for the first 9 months. That's a wash. It's even. There's really, it's no percentage. Okay? Now, it's not below the line, but it's pretty much right at the line. Okay? So that's not a home run. That's not time to spike the football. Okay, we're getting some disciplines in place. That's fantastic. But don't get so excited. Don't be so over-optimistic that we forget to pay attention to the momentum in collecting profit. Professional print did a lot better. They did $85.3 million on their $1.4 billion in revenue, which was 6%. But ladies and gentlemen, when you put those things together, it's like 2%. If you put those two categories together based on their revenue and their operating profit, it's like 2%. Again, it's not time to spike the ball at 2%. It's a hell of a lot better than being in the red, and especially being in the red, millions of dollars. So there's a momentum, it appears, in Konica Minolta, where they're turning the bus a little bit and heading down the right road to collect more profit. We'll see how they continue to do that. But I do have a question with corporate, etc., and I'm going to share another slide in a second here, but I need to know what's in corporate, etc. I went all over the, the financial. I couldn't find what you're putting in that bucket of. But right now we're at $105.2 million in a loss of operating profit in that category. And what's in that category? What is that $105.2 million in cost management, if you will? There's something going on there. What's happening? Where's that money bleeding from? In the third quarter, it was $40.4 million. If you wanted to be cynical, you would say something like, are they taking some of the cost out of this digital print and the professional print space and dumping that cost in corporate, etc., and showing the loss there? That would be what someone cynical would say. I'm not saying that, but at the end of the day, that's kind of interesting to me. We need to know what that's for. So I wanted to go to this page because we're talking about the forecast. And I want to ask, I really want to get into this corporate etc. a little bit because they're actually projecting that they're going to have $144.8 million operating profit loss in that sector, and they increased it by $15.2 million. So what happened last quarter or the third quarter? They said, hey, we got to increase the losses we're going to have in operating profit in corporate etc. by $15.2 million. That seems to be a big number. But I want to come over here and I want to focus on, they kind of talk about things that are going on, things that they're doing, and how they're positioning themselves to forecast what they're going to forecast. And I want to start over here. It says, business with stable profit, office production print. And look, I'm excited that you all have operating profit, but I would not call it stable. And I'm not saying that to be mean. It's just the reality. We're at 2%. We've struggled for 10 quarters. We're not stable yet by any means. And it's like, you're on the 10-yard line and you still got 90 yards to go. You don't spike the ball and say, we got a touchdown. And you can't bet on the Hail Mary. You have to learn to play the whole field. And Konica Minolta, I just think I think sometimes we get way too optimistic in our goals. And I don't know if we got the discipline to carry those out. But it says, implement structural reforms to make sales service management more efficient and higher quality. And folks, I want to focus in on the word higher quality. When you're talking about management, you're talking about sales teams, and you're talking about bringing on higher quality candidates. Higher quality candidates, no matter who you are in our space, if you want a higher quality candidate, that higher quality candidate is going to have some business acumen. And you know what they're going to ask you? What do you do besides print? I mean, print. What do you do besides print? And you could say we have DW, DX, and we're going to digitize the world, and we have IT services and cybersecurity services and penetration testing and all that great stuff. But if they're the right people, if they're a higher level person, if they're a higher level executive that you want to bring on the team to help drive your business, they're going to want to know the details. And maybe you don't want to share those details publicly. I think you should. But you're going to have to at least share them with those folks. And I hope you have them to share, because sometimes when I look at the way the OEMs present their financials, they really kind of hide all this other stuff they do that they brag about they do so well. But here's something I found really interesting. Revise manufacturing strategies in consideration of geopolitical risk, including partner strategies in the medium to long-term perspective. Remember when I was saying a while back that we're going to see manufacturing roll up, that we're going to see OEMs kind of outsource manufacturing? Well, it appears to me that Konica Minolta is actually thinking just that. They mentioned the word geopolitical. That could only mean one thing, and we all know what that means. It means China. And, you know, for a long time, folks, we've seen Konica Minolta and Nine Star kind of courting each other. But we're also seeing some pretty good pressures on the geopolitical arena between China and Americas and Europe. And the balloon thing just this weekend is an indication that we're starting to have some real pressures around geopolitics. And it's going to really put some pressures on our industry. We better be ready for it. We thought supply chain was an issue. Well, when we turn geopolitical issues into Cold Wars, we're going to have some pretty tough issues to get through. But they are paying attention to that, just like all the OEMs are. But folks, I'm telling you, you can't get too excited about aspiring to have a 2% operating profit. You can't get too excited. You have to make sure you have the disciplines and get excited about those disciplines. This is the other issue that we got to kind of watch, and I'm a little bit concerned about at Konica Minolta, is their cash flow from operating activities for the 9 months into FY 2022 is $127.1 million negative. And look, you know, cash flow from activities, you know, it can fluctuate, okay? And there's sometimes you do actually go below the line. But it can't be a lot, and it can't be like, you know, continuous. It can't be a seesaw. And we've noticed that the first quarter, they were 133.6 cash flow upside, and a downside, and 68 million in the third quarter, which is the one we're talking about right now. So that's a concern. And I would ask Konica Minolta if the DW and DX were in its own business. So if you scrape that out of Digital Workplace completely, it was its own business, had its own leaders, that's all they did was sold DW and DX, what would that look like? Would you have free cash flow? Would you spend more than you're making? It's just a question, because if you're spending more than you're bringing in, that's not a good place to be. And so, you know, this slide here is kind of their performance overview, and I just had a couple of questions. You know, they said they're 86% of FY19 levels in non-hardware sales, and you know, things are coming back. And here's the question. It's just a simple question. What was the impact of dealers stocking up over pre-COVID levels? So in other words, if you're growing, if you had a great quarter and you shipped out a bunch of stuff, was that bunch of stuff going in end users' equipment? Was the equipment going in end users' offices? Was the supplies going in end users' printers or copiers? Or was it going in the dealers' warehouses? Was it going in distributors' warehouses? I mean, because a lot of folks, they went through some tough times. And when they get a chance to say buy now, if you will, they're probably loading up, especially some of our bigger dealer friends. And that's a concern, because if they load it all up, you might not see any results in quarter four. And we all know by your aspirations, you got to have a pretty good quarter to hit those numbers. And what's the split between hardware revenue and services revenue in DW and DX? I mean, we could talk about all these aspirations and IT services and all that stuff, but we really got to start getting to know these numbers a little bit deeper, or it's just not really going to make any sense. And so their earnings forecast, you know, at the end of the day, they want to have a revenue of $8.3 billion for the year. We'll see how they end up in their fourth quarter, where it ends up. And they want to have $113.4 million in operating profit, and that would be a 1.25% for the whole company. So we're going to go from this 0.5%, If we can do everything we're supposed to be doing in the fourth quarter, we'll end up for the year with 1.25%. Folks, I got to tell you something. I appreciate staying above the line, and hopefully you do. But that can't be your goal going forward. Your goal going forward can't be to do 2, 3, or 4% operating profit. Your goal going forward needs to be 10, 11% operating profit. Your goal going forward needs to be bringing in more money than you're spending on a quarterly basis. And I'm just hoping that we're positioning ourselves to come in to FY 2023 with a lot more stronger aspirations and goals. Because I really have a concern, not just for Konica Minolta, but I'm thinking Ricoh as well. Like the Ricoh and Konica are the two biggest players in our space that are transitioning into IT services. But I'm really starting to have a concern on whether they can build out organically a services business that's profitable. I'm just having a concern based on what I'm seeing. So this page, they talk about some segment information, and I kind of put this over here, the Workplace Hub, because it says here, before March 31st of 2021, the digital workplace business was Office OP, IT Service Solutions, ITS, and Workplace Hub. And April 1st of 2021, they made some changes. It says Office and DWDX, and then the DWDX is where they have the Workplace Hub. I guess I put over here, I said, did they finally get rid of that thing? You know, folks, here's the reality, and I've been kind of joking about this Workplace Hub for a while now, along with a lot of other people in the marketplace. But sometimes dreams, you know, they're great as long as you're sleeping. But sooner or later you'll wake up and you realize it was just a dream. And I'm just wondering if it's time to wake up. Is this one of those painful decisions that we might have to make? Is this thing really a viable product going forward? I really strongly question that. If they would share real details around the numbers, then maybe I would think a little bit different. But when I look at the numbers overall, I don't think it's that exciting. But I just wanted to bring that up. So digital workplace, that's where that DWDX is. We think about DWDX, we think about IT services, right? But here, you come down here to the glossary. And you know what's interesting about the glossary? They don't really talk about services. They don't talk about any kind of services as a particular, like assessment services, advisory services, compliance services, cybersecurity services. They're still thinking, and this is for all the OEMs. We're still talking about segment 1 is 20 pages a minute. Segment 2 is 21 to 30 pages a minute. Who gives a crap about that? Is this really where our industry we're still thinking like we were thinking in 1990? I'm sorry to say, this is for everybody. Folks, I could put a 50-page a minute desktop printer right there on that table, and I could probably spend about maybe $1,000 at the most for it. It's not 1990 or 1980 when we were focused on this speed thing, and the speed determined the dollars and the value of the machine and how many pages a customer could run and all this crazy stuff. Because no one's hitting the volumes on any of these segments. Maybe we should rethink of all that. And maybe we should rethink about making 1 million different machines. That would probably help us do what? Be more profitable, I'm thinking. Anyway, I just wanted to share that. But I wanted to really dig into this DWDX. And on Konica Minolta's financials, they share the information. And they broke it out. So they got Office, DWDX, and operating profit. Operating profit, let's start with that first. So I got this red line here just to separate this out. So I'm going to share this with you. But when you look at the operating profit from FY 2019, 2020, 2021, you could see that we are not knocking it out of the park in any way, shape, or form with operating profit inside the digital workplace business unit. And in that unit exists IT services, all the 24 companies that Konica Minolta bought over the last 15 years. All that stuff sits in that DWDX space, right? And look at this. You can see, we're at barely any percentage here in quarter 4 of 2019, and even in quarter 1, quarter 2, and quarter 3 of 2019, very low operating profit. And you can see it still goes low. And then we get into some big negatives, negative. And again, quarter 2 and quarter 3, we're showing a little bit of profit, but still not near enough. But when you look at this DWDX, and I wanted to take the math out, okay? So I did the math. So 19% of the office, if you take that digital office workplace business, okay, where IT lives and all the printer stuff lives, 19% of the total revenue that is coming from DWDX. $532.8 million in 9 months was DWDX. Total for the group was $2.8 billion for 9 months. So it's 19%. So on the surface, we're less than 20% of our revenue is coming from services. But the problem is there's so much involved with DWDX, and those buckets really have to be defined, and I'll get to that in a minute. But folks, here's something I did. I took the professional print business and I added that to the digital workplace business, came up with a total number for both of those businesses, and the DX percent of revenue out of professional print and digital workplace, well, it's 1.25% of that revenue. So if you think about Konica Minolta as the professional print, that's still a print business, right? Print, it's just industrial and high-end professional print, right? And their marketing stuff they're doing. But digital workplace is all that print. So if they were to spin off Konica Minolta, if you will, let's say they spun off the digital workplace, they'd probably spin off the professional print with it, wouldn't they? Probably. If they did that, the DWDX within that number together would be 1.25% of that revenue. That's really, really low. Quite honestly, I believe if you just left it in the digital workplace category at 19% of revenue is not near enough after having this IT services capability for over 15 years. It'd be nice if that was like 40%. Then you would see a real services company. Then when you went out to hire human capital that wanted to change the world, wanted to come into an OEM that was a manufacturer and really wanted to help expand the growth in their services, they'd be all excited about that. They wouldn't be too excited about joining at 1.25% of total revenue when you look at their print business. They would probably ask you, what's happened over the last 15 years? And so this slide here, I wanted to just ask the question one more time. Can the OEMs that were built for manufacturing really move into services? And I just don't think they can. So I want us to think about Konica Minolta, and I want us to think about All Covered. All Covered, the shining star in the hill that Konica Minolta bought about 12 years ago. And where are we at with that? What was the revenue when they bought it? And I'm going to share that number. I finally found it. And where are we going with all of that? But here's the reality, folks. And we just really need to think about this. I took North America. What's the DWDX just for North America? And by the way, North America and Europe are pretty much the same percentage, of total revenue out of Konica. It's about 36%. So when you take that total DWDX revenue and you look at what's being thrown into the American bucket, if you will, it was $185.1 million over 9 months. $20.6 million. If you run that run rate for the whole year, that's a $246.8 million business, all of DWDX. A while back, I was talking about All Covered, and I said I don't think All Covered could be more than $200 million. I think I'm pretty close on that. I think it's actually less, because this $246 million in the U.S. would be all of the DWDX. That's the workplace hub. That's all the ECM stuff. That's the ERP stuff. That's everything they're doing in DWDX. And so it seems to me that that IT services piece of that isn't near as big as what we might have thought. And of course, they're more than happy to share the absolute details of that. But Konica Minolta acquires MSP All Covered in 2011, and the reported revenues were $60 million. I'm going to show you that right now, folks. So think about this. They bought that company. It was $60 million in revenue. There's the press release, came right out of CRN. We're 12 years later. What's the real reality? In this news article, they said they wanted to grow at 100% in the 12 to 18 months. That was their aspiration. They bought a $60 million IT services company. They wanted to grow at 100%, put them at $120 million if they achieved it. It's been 12 years. My guess is they're just a little bit north of $120 million now. And I realize that some of their revenue might be in Europe, but how much really? They just really started talking about that this year. And, you know, folks, does the IT service and investment community still believe the dreams of 15 years ago? This is not to Konica Minolta. That question is to all the IT folks out there. Do you still believe in the dream that the print sector is this place that you could merge with or sell your company to, and they're going to go and, take you to the glory land? Do y'all still believe that? I don't think a lot of you do. I think a lot of you, if you're starving, if you're on the verge of maybe bankruptcy, you might get excited if a print OEM or a big print dealer comes and gobbles you up. But realistically, if you're a real successful IT services company in the marketplace today, and you're not chasing revenue and your momentum's toward profit and doing things remarkable, you're probably not that interested in becoming part of a print dealer. I'm just saying, folks, because the history of what's happened over the last 15 years isn't anything to write home about, I don't think, from any of the players. How many were profitable over $5 million in revenue? And that question is to All Covered, because All Covered says in this article they bought 16 companies within 3 years of Konica buying them. So, when Konica bought All Covered, it was all undisclosed. These are undisclosed. So was the pressure of All Covered buying 16 organizations too much pressure? And Konica Minolta came in and kind of bailed them out, if you will? And then they took the bailout and they decided to go out into the marketplace and make something great, get 100 times the revenue. Remember, folks, I'm just asking the question because I believe that All Covered probably bought 16 companies because they say they did, but I'll also believe that a lot of those companies were probably sub 5 million, probably most of them sub 3 million, and probably very few of them were knocking it out of the park with profitability. And so the question is, can we really continue to do this as an industry? Sometimes you got to go back in time, right? So here's all the acquisitions that Konica Minolta has made. And folks, I might have missed one. I went to their website. It's all there. And I didn't want to put anything that had to do with print. So these 24 acquisitions were made in 15 years. And we know that All Covered bought 16 companies the 3 years before Konica Minolta bought them. So if you think about it, there's a collection of 40 companies. All Covered bought 16. Konica Minolta bought 24. And this all happened over the last 15 years. Can we really collect up 40 companies and be able to go into the marketplace and deliver services of these 40 companies with any kind of profitability, with any kind of sense? I'm asking the question. Here's something. This is a little bit cynical, but I got to ask it. This is one of my Rayisms, if you will. You can buy an outdated donut cheap, but you will never make it fresh again. You can buy an outdated donut cheap, but you'll never make it fresh again. And I got to bring back our friend Orlando Bravo's quote off Twitter. Astonishing the number of private companies that continue to try to buy up their way through growth instead of focusing on building a real business organically. Folks, here's the bottom line. We got to figure this out. Because I still hear people in the marketplace telling everybody to go buy up dealers. Go buy up dealers. Go buy up IT people. I don't know. I heard someone talking the other day. They were doing one of those little mini videos. And this is a senior person in our industry, okay? And I should say just a senior executive. They're not really with an OEM or anything. I'm not going to say who it is. You probably saw his video. But at the end of the day, they're talking about how venture capital's all excited about our industry. No, they're not. Change the word venture to vulture. There's some vulture capital out there all excited about our industry because they're going to gobble up some assets that they might be able to financial engineer, strip some money out of, and that's the end of it. But if you honestly believe that there's venture capitals out there looking to invest in the print business, I question the sanity of these venture capitalists, and what in the hell are they seeing? Are they still buying the stories? Because the history has proved it totally to be a fabricated fantasy that we're going to transition into anything that has anything to do outside of print and with any real substance. I'm getting close to the end here, folks, but I wanted to ask a few questions. And Konica, I really believe you have to define the buckets of your DWDX. So as an example, you have IT services bucket. You have selling the assessment as a bucket. You have advisory services as a bucket. You have compliance services as a bucket. Security services as a bucket. ECM services as a bucket. Penetration testing as a bucket. Are you bucketing all these different deliverables inside DWDX? And then the question is, are you bringing in enough revenue in each one of those buckets so that you actually make a profit from each one of those buckets? Are some of those buckets losing money and you're making the money in other buckets? Because in a services business, you can't run it that way. Every single bucket has to be profitable. Every single bucket has to be profitable. Or you need to kick the bucket. Something to think about. I do want to bring this up over here. They talk about, they said the conversions of order backlog into revenue in quarter 3 of about 159 million. I want to read that again. Conversions of order backlog into revenue in quarter 3 about 159 million, which was basically 16% of the 1 billion total office third quarter revenue. So the question is, are people buying up inventory? And I've already asked that, because if that's the case, you might find yourself in a little bit of a pickle going forward. And DWDX, the revenue's up 3%. But again, what bucket of the revenue's up? Are you selling a bunch of ERP systems, because that's one of the companies you bought? Are you selling a lot of ECM, because you bought a lot of that technology? What's up? What bucket's up? Is it really IT services? Ladies and gentlemen, a couple things I want to end with. The cost in and of accountability is an investment profitable companies make. The cost in and of accountability is an investment that profitable companies make. And the OEMs out there and all the dealers out there, we got to start really investing in accountability. We got to really start improving our operational maturity, if you will. We've got to start a momentum towards profit. Organic growth demands accountability. It's immediately. It's reality based. I want you to think about that. When you're growing organically, you have processes in place, you have accountability in place, hopefully. You got a momentum for profit, and it's based on what you're actually doing. It's not based on any fantasy. It's not based on, hey, let's buy up a bunch of companies, add all the revenue to the pot, and hopefully it all works out. Because when you do it the other way, well, I think it's just a fantasy. I think you procrastinate. You procrastinate your future profitability. You think it's going to be a home run one day. And when it turns out not to be a home run, you run out and you buy somebody else. We got to end the shopping sprees. We got to focus on profitability. And we got to put our IT services in buckets. And we cannot spend more than we make. That's a recipe for a disaster. And everybody watching me knows this. Status quo is the killer of all that'll be invented. Don't get stuck